Mutiu, please help us record.
When you have two professors that are presented before you, it's really difficult to meet their expectation. So I will just try my best. Okay, we'll be doing corporate financial accounting. Can we all hear me?
Yeah.
Yes, we can.
Great. So I will go through the slides and I will also do my best to explain as much as I can. In the course of the presentation, if there are questions, please let me know so that we don't lose track. We'll focus on what accounting is. We'll be as fast as we can. We'll talk about the attributes. We'll talk about who are the users of accounts. We'll talk about financial and managerial accounting. Briefly, we'll also talk about GAAP. GAAP means generally acceptable accounting principle. We also talk about a simple account and the business cycle of business. We also talk about balance sheet and also talk about certain mechanics. What is accounting? Now, basically, it's just an information system that helps us register, that helps us classify, and also summarizes financial information. One thing is important: transactions we must be able to express transactions in monetary terms before we can talk about recording or posting. Some information that come in non-monetary terms, they can only be disclosed, but we can't recognize them as an account. Sometimes translation into monetary terms may be immediate. For example, purchase. Hello, are we there?
Tommy, please, can you put it on slideshow?
Okay, hold on. F5. Are we good?
Yes, fantastic, thanks.
Okay, great.
Oh, I can't see it here.
Can you see it?
No, I cannot.
Can we all see it?
It will still come to you. Maybe your internet is slow.
Yes,
We can see it.
Okay, great, thanks.
Yes, I can.
No, great. So one thing is important. Information, we should be able to express them in monetary terms for us to be able to recognize them in a financial statement. Financial statements are basically built up of financial transactions. If transactions are not in monetary terms, it will be difficult to build up a financial statement. Sometimes the translation can be immediate. For example, if I purchase a motor vehicle that is worth 200,000, I already have all my information to convert into a transaction. What are the attributes of an account? The information that we have should actually be relevant. It should be relevant to the business or to the entity that is being considered. It should also be reliable. In which case, if two or more persons look at financial information, it should give the same information that is expected. It should also be comparable. Before now in Nigeria, we had comparability issue because Nigeria was preparing for using the local GAAP. But with the advent of IFRS, it's easy to compare financial statements across jurisdictions and across industry because everybody is using the same generally acceptable accounting principle, which is what is called IFRS. In full, IFRS is International Financial Reporting Standard. Someone that has some minimal level of financial intelligence or financial education should be able to understand financial statement, which I'm sure is why a lot of us are here. In practice, reliance and relevance, they may oppose each other, but we see a lot of this as we go on. Who are the users of financial statement? Who are the people that need financial information? There are many users. One of the users is lender, or who we call creditors. Creditors are interested in the ability of a business to pay whatever is collected. So a creditor is usually interested in the financial statement for the purpose of ensuring that the business they are lending to currently performs well and will be able to meet up with its obligation when time of repayment is due. Hello, can we all hear me?
Yes, we can. Please go ahead.
Yes, we can.
Okay, investors also need financial statement. Investors, there is something that is called potential investors, meaning that they are not currently shareholders of a particular business, but they are interested in investing in a business if the financial metrics are right. So they look at the financial statement to be sure that the company is doing well and the company will continue to exist into the foreseeable future in order to ensure the safety of their investment. Current investors, they are the shareholders. They are also interested in the financial statement so that they are sure that the return on their money is appropriate and also their investment is also safe. They are also considering whether they have to leave their money in this business or they consider other viable investment where they can put their money and get better returns. So investors are also interested. Government agencies. Government is interested in financial information and financial statement. For example, tax authorities, they want to check whether a company is actually paying the required level of tax based on their performance and whether the company is also meeting regulatory requirements. A CBN, for example, for banks, will be interested whether all the necessary financial ratios are met. The liquidity, the loan to deposit ratio, the capital adequacy ratio, the capital, the reserve with banks, investment ratio, and all those. So government agencies are also interested in financial statement. Unions, workers want to be sure that this company that is currently paying my salary, they are profitable and they will continue to be in business for them to be able to meet their financial obligation as it relates to me as staff. Competitors also review financial statement to be sure how they are placed within the industry. They want to know how the other businesses are performing so that they can come up with strategies, if possible, to outperform the other businesses. Managers, we know that we always say that management is different from ownership. Ownership are shareholders, but managers are people that manage the business. They need the financial statement to be sure that the financial statement is communicating relevant information to the external parties, and all the information communicated are in line with the business reality and economic reality of that business. What does each group prefer? For external, they usually want reliability because they are not part of the management of the business. They want to be sure that the information that is presented in the financial statement are reliable. And one thing that external guys do is to rely on auditors because auditors provide assurance on the financial statement. For internal purpose, managers, employees, they want relevance to be sure that the financial information or the financial statement communicates appropriately the current financial position, the financial performance, and the cash flow position of a business. Now, I won't spend so much time on this. Financial and managerial accounting. For financial accounting, it ensures reliability. It ensures appropriate standards are followed. It also focuses on historical data. Events that have happened in 2019, events that have occurred in 2018, and like that. But they are really not futuristic. And it's also auditable, something that an independent professional that we call auditor can look at and audit. Managerial accounting ensures relevance. How relevant are these financial information to what is happening in the economy? Now we are in the period of COVID. Will this company survive this lockdown? In the period of reduction in sales, are there strategies in place to ensure that the company gets back on its feet? Forward-looking information are considered for managerial accounting, going concern information, forecast, projections, and because they are for internal use, they are for managerial use, most times they are non-auditable, which is why financial information and financial accounting is what is basically subject to annual audit. GAAP is what is called generally accepted accounting principles. It's used globally. It is just the convention, the principles that are used in preparing financial statements. In Nigeria, our GAAP is IFRS, which is called International Financial Reporting Standard. IFRS are issued by a body called IASB. IASB is International Accounting Standard Board. This is a board that issues all IFRS. At the moment, we have about 16 IFRS, IFRS 1 to IFRS 16. We have IAS, I think about 41 in all. Standards that have been issued. Now, what IASB does is, every year, they tend to issue new standard. There's IFRS 14 that they have currently, IFRS 17 that they've currently issued, that will be in use, I think, from 2021 thereabout. On a yearly basis, they review transactions, they review challenges. I'm sure very soon there will be something that will cover COVID-19, if currently we don't have any such of things in place. Though we have something that covers disclosures, but they may want to be more specific and bring something that affects maybe global menace as COVID-19. These have been generally accepted by convention, by rule, and by regulations. And these are also country specific, although harmonization is happening. In terms of GAAP, we know US, they always want to have their way. US currently do not use IFRS. They have their own standard, but what they do is they ensure that their standard majorly aligns with IFRS. There is a convergence project between US standard producer, which is called FASB, Financial Accounting Standard Board, and IASB, to converge all relevant accounting standards. Basically, in financial statement preparation, there's something that is called measurement. Measurement talks about recognition of a particular transaction. It talks about the timing and basis of item, which we recognize in a financial information. If I take an example, if I buy a motor vehicle for 100,000, measurement is that how much should I recognize in my books for that motor vehicle that I buy for 200,000? Timing talks about at what point do I recognize it? Do I recognize it now or I recognize it later? Disclosures are information that complement the measurement in a financial statement. I think I have some charts here. Okay. Let me continue. What is the simplest accounting system? Cash accounting. No thinking required. Cash accounting just says that you recognize everything that you do on cash basis. Whether you have future obligation or not, we are not concerned about that. We are only concerned about cash transaction. And we have seen that this may not be reflective of what happens in practice, because transactions could have been entered into even without movement of cash. So there are a lot of disadvantages. There are a lot of shortcomings of this form of accounting. But we just take example of, hello, are we together?
Yeah.
Yeah,
Okay. Okay, I'll just take, we go through different types of cash accounting just to look at transaction. A partner contributes 32,000 to a business. First thing we must recognize is that, is this a transaction The answer is yes, because it can be measured in monetary terms of 32,000. If they just tell us that the partners contribute capital to a business, there's nothing you and I can do because we don't have information about the contribution. But we have information that the partner contributes 32,000. That is a transaction. And because it's a contribution to a business, it couldn't have done that on credit. It can only be done on cash basis. So this is a cash transaction. And in every transaction, the second thing we must do is that we must identify the accounts that are affected. If we are unable to identify the accounts affected, there is no way to post the accounts, whether in T format or using accounting equation. Even though we are focusing on cash accounting here, I want us to identify the other accounts that are impacted. Partners contribute 32,000 to business. This impacts cash. Which other account is impacted? Hello?
Equity.
Owner's equity.
Owner's equity.
Owner's
Correct.
equity, yeah.
Owner's equity. Now,
Owner's equity.
correct. That means cash
Owner's
increases.
equity.
Excellent. Cash increases, owner's equity also increase. Okay. Purchase of equipment for 21,000 in cash. Now, let me say something. Most times when transactions are done in cash, they always specify. When there are no specifications, we assume that the transactions were done on credit. Purchase of equipment for 21,000 in cash. This is a cash transaction. What are the two accounts that are impacted?
And equipment.
Correct.
Cash account.
Equipment and cash. Now, because we are buying in cash, we are paying in cash. Cash reduces, which is why it's denoted in minus.
Yeah.
Now, equipment increases. So when we are posting equipment, we should recognize that increase by showing that it's a plus. Now, say of 230,000 naira. Who wants to tell me why was this not recorded under cash accounting?
Because it didn't say paid in cash. It just says
Exactly.
sale of 230,000.
Correct. Onyema.
So it's
It doesn't
assumed to
mean
be
that-
credits.
Exactly. It doesn't mean that this transaction will not be posted. It will be posted, but none of it will be
Not-
posted into cash.
In cash accounts. Okay.
Exactly. It's not going to be posted in cash account. Sale of 230,000. But let's assume we are posting this. Who wants to tell me which two accounts are affected?
Sales and
Sales
revenue.
and
Revenue and I think sales and revenue. I'm not sure. I know revenue is affected.
Oyema, you missed it.
Cash or
Umi, do you want to tell?
Cash is not involved because they did say that it was receiving cash.
okay, cash or bank, sales and assets. Yeah.
Wait, oh.
Assets, yeah?
Of bank.
It's unfortunate. You can't identify assets, yeah?
I'm looking
Latin
at
fact.
I'm
You
looking
want
at
to try?
inventory and revenue.
Why is it
Receivable. Account receivable.
Okay.
They said collection. They've collected the money now.
Wait,
Account
wait.
receivable.
no, it's sales. It doesn't mean
They've
they've
not
collected the money.
They've not
So it's
collected the
account
money.
receivable.
It's
It just
receivable.
said sales.
It's receivable and revenue. Receivable revenue.
Oh, so I thought you were talking about collection of 210. Sorry.
Receivable
Onyema.
and revenue.
Is that your final answer?
Yes, account receivable
Yes.
and revenue.
Yeah, because if it is not sales, it will be receivable. Sales is credit.
That's correct. That's correct.
That's just
So-
about it. Hello.
Hey,
God
Femi.
have mercy.
Yes?
Let me receivable
Yeah.
and inventory. Receivable and inventory.
Okay.
No.
I guess that's Collins. Collins, why are you saying inventory?
Yeah, receivable and inventory.
Why are you saying?
Because you sold 230,000.
Okay.
You sold 230,000, which means your inventory is impacted because goods have gone out, but you've not collected cash. So yeah, it's assumed that you sold on credit.
No. Yeah.
It's assumed I sold on credit.
Yeah.
You're correct with that assumption, but on the accounts that you've recognized, you are not correct. What they've said is this: sale of 230,000. To complete this, what they have said technically is that I've sold 230,000 on credit. We agree with that?
Yes.
Yeah.
So first, there is a revenue account, which is a sale account. Because I've sold on credit, I have someone that is owing me. So I need to create an asset for that transaction. So the asset is account receivable. I have
Yeah, that's
sorry,
recognized. Yeah, let him finish. Yeah, go ahead. What's the second account?
Now, the first account is sales, which is a
Yeah.
revenue account. The second account is account receivable,
Receivable.
which is an asset account.
Yeah.
Now, they did not talk, we are not going to inventory because they never mention anything about cost of goods that I've sold.
Yeah.
When they talk
Yes.
about cost of goods that I'm selling, I will then go to the inventory and take care of the goods that are warehoused in the inventory that I sold. Here, they are just focusing on the revenue transaction,
Okay.
which is to say that I have made revenue of 230,000, but the people I sold to, they did not pay me in cash.
So the sales account.
Femi, let me cause a bit of problem. Sorry, I will jump a bit forward. If the next line now says receives cash of 230 for goods sold, right? I know it's going to now impact inventory. Now the question is, if I say receive cash of 230,
No.
hold on.
Oh, yeah, man,
No.
it's not going to
Really?
impact inventory.
Okay, so it's
not
going
going
to
to
impact
impact
cash
inventory.
and receivable. Receivable will come back down.
Yeah.
Cash will go back up.
Excellent.
Okay. Okay, go on.
Yeah.
I just want to be sure.
So Femi, I think one thing that I've seen in this in accounting is you see this activity when you sell something. Say for example, you sold a car for 230,000. Now different statements can be made, like sale of 230,000 did not specify what actually was sold, right? Now, but it's recognizing the fact that there's revenue, right?
Yes.
And so you first recognize the fact that there's revenue, then you recognize the type of revenue. Was it cash? Was it credit? If it's credit, then you'll be talking of account receivable.
Yes.
The fact that you've made some sales.
Yes.
Then
Yes.
if the same statement, well, the same transaction, you could have said, I sold the car for 230 that we bought for 200. Now you're still saying the same, you're talking about the same transaction, but this is a different accounting you're talking about entirely. Is that the way it is?
Exactly.
Because
what they've done. Okay, go ahead.
Yeah, because at that time, when they say a car we bought for 200,000, we sold for 230, and you are saying the same thing that happened earlier, but then you are talking of a different accounting now. You're talking you're talking of the fact that, I mean, that's when what Oyema or somebody was talking about will come into play. That's the fact that inventory will be impacted then.
Yes, you're very right. Now, we must be able to identify, we must be able to split transaction. In a particular sentence, there may be two transactions stated in that sentence.
Yeah.
Now, if there are two transactions, you need to make postings for two transactions.
Exactly.
If there is only one transaction, you only post for one transaction. In this example that we have, the transaction is only sale.
Yeah.
So we post that sale transaction. In the other example that Tunde just made, a vehicle that was sold for 230,000 was purchased for 200,000. You will note that there are two transactions they have given us: a sale transaction and a purchase transaction. Are we together? Hello? Are
Yes,
we
we
together?
are.
Yes,
we
yes.
are.
So in that case, we have to post the sale transaction separately. We then post the purchase transaction separately. So the sale transaction will be between revenue and account receivable. And the purchase transaction will be between inventory and cost of goods sold. Now, collection of 210. Somebody may say that, but they mentioned collection, they didn't mention cash. Why am I saying that it's cash? Who wants to try?
Because if you say collection, then an instrument was collected, which could be cash as in cash or check. When it's check, it's actually cash. It's assumed cash as well. So
Yeah,
if you have collection, then an instrument was paid or given in some way.
That's correct. Thanks today. Because we've already said collection, it's already showing us that it's a cash transaction. Because for
Hello,
the
Femi.
Hello?
Yeah, Femi, I wanted to ask, that check, is it not the same thing as note payable or something?
Check. Which check? Which check?
Where Olatunde said that the collection of 210 shows that it's either check or cash, and check should be stated as cash.
Okay, because
Can be stated as cash.
Okay. When you collect check, it's taken as payment in Nigeria, and as far as accounting is concerned, it's an instrument of payment. It's a legal tender. So you take it as cash or bank. Now, if you want to
I thought check goes as bank.
Yes. Here,
Okay.
we are just using cash for everything that is either bank or cash. If you want to be specific, you will separate cash from bank. But what you see is, you see cash and bank. But what this has assumed is that everything is cash. It's going to give
Everything
you
is cash.
eventually.
Okay.
But if you want to be specific, you can separate cash from bank. Cash is talking about cash in hand, the cash you are keeping in your till box, while bank is talking about the money in your bank account. This kind of business is assumed that all transactions are done through the bank. So you can either call it bank or you call it cash. But for a financial institution, we have to separate cash from bank because their cash in hand is different from cash at bank. The cash they have in their vaults, those ones will be cash in hand. But the cash they have with other banks or with CBN, those ones will be taken as cash in bank. So the cash can be cash in hand or it can be cash in the bank. So if you want to separate, you can say cash and you have bank, but you can also call everything cash. We are still in the same line. I think I need to move a bit very fast.
Hello, Femi. Are you saying that?
Go ahead.
Yeah, are you saying that like this collection of 210, that even though they didn't say it's cash, that we can assume that it's cash, or what are you saying?
Because when you collect, it's cash you are collecting. If it is not cash, because collection is a cash activity, so they don't have to say collection of 210 in cash. If collection is not cash, they will have to state it expressly that it's not cash. They can say collection of 210 in inventory. I then know that what I've collected is not cash. It is inventory.
If I see receive payment of 210, what do I take that as?
That's cash. You've collected money.
Cash.
Collection, receive payment, cash.
Receive.
Okay.
You only receive or collect an instrument.
Exactly.
Yes.
Of
but
payment.
if it is not cash, if the collection is not cash, they will then go an extra length to be specific on what you collected. You know, it's possible that I sold goods to someone at 230. Instead of the person paying me cash, we agreed a trade by barter. The person gave me another asset. So in that case, they may say collection of 210 in inventory. So instead of debiting my cash to show that my cash has increased, I will take this plus 210 to inventory because what I collected was inventory, not cash. So if they are not specific on collection, it can only be cash that you've collected. Or if they just say receipt or payment, it has to be cash because it's a payment activity. An example is this, payment of wages. You can see they didn't say payment of wages in cash because the payment is seen to be a cash activity. Are we together?
Yeah.
So that's reduction. Now, we can see that some has positive, some has minus. There is a standard rule. Anything that is an asset, cash, is cash an asset or a liability?
An asset.
An asset.
Asset is what you own, what belongs to you. Liability is what you owe, your obligations. Anytime an asset increases, we must debit or we show it as a positive sign. But anytime an asset reduces, we credit, we show it as a negative sign. So that's why we have positive for some to show that our asset increases and negative for some to show that our asset reduces. The other one, purchase of merchandise for 180. We can see, they just say purchase of merchandise. I can purchase on credit, I can purchase on cash, but they have remained to be silent. So I will assume that this is a credit transaction. It doesn't come into cash accounting, but it will go into accrual accounting. Payment of 160, they said payment. Because it's a payment, it's a cash transaction to suppliers. Okay, we move on. What problem does cash accounting have? I think we've talked about this in the class before. I'll just talk about it briefly. It really does not show the true position of a business. For example, there are two transactions that this business entered into that was never recorded. So when we are preparing our balance sheet using this cash accounting, it doesn't show the true position. And it may also be misleading. It does not also help in making appropriate decision by a business. So there are a lot of reasons that we can allude to that. We move forward quickly. We go into the business cycle. This is very important in financial statement preparation. Every business has a cycle. If we are starting up a business, what a businessman first looks at is, for me to run this business, what do I need to do? I need assets to operate this business. How much will my asset cost? So a business requires financing. Financing is what we use to acquire assets for the purpose of running our business. Financing is the funds that is used to acquire an asset. The acquisition of the asset itself is called investing. Now, I go back to this financing. Financing are provided from two sources. It can be from the owners of a business, which is what we call contributed capital. This can also be from creditors, from lenders, from banks. They are all part of financing. So the financing in our accounting equation, they are in the liability side, which is the liability plus owner's equity. When we raise finance, for the purpose of this class, let's assume we raise 20 million naira. The 20 million naira will not just sit in the bank for us to run our business. We must use that money to acquire relevant assets to run our business. When we invest that money to acquire assets, it is called investing activities. We invest in assets for the purpose of running that business. Now, when we then continue to use those assets to run the business, to do our operations, it becomes operational activities. This is the life cycle of a business. And when we are preparing cash flow of a business, that is what the cash flow of a business shows. It shows the operational activities, the cash flow that I generate from my operation, the cash flow can be positive, in which I'm making more money than I'm spending. It can also be negative, meaning that I am spending more money than I'm making. From operational activity, we go to investing activity. In our cash flow, there is something that is called investing activity. All the monies that I spend to acquire long-term assets, not short-term, long-term assets, fixed asset, for example, investment in shares, investment in long-term instruments like bonds. They are called investing activities. But when I start borrowing money from shareholders, borrowing money from banks, paying back the interest on the money that I borrowed, they are called financing activity. So in a typical cash flow, you will see operational activities, cash flow from operations, you will see cash flow from investing, cash flow from financing. Let me move a bit quickly. That's what we've shown here. A business gets funds from owners and lenders. This is an example of our accounting equation. The lenders and owners here, they are the liability and the capital side. While the firm or the business invests that money in productive resources, that is the asset side. At every point, asset must be equal to liability plus owner's equity. Before we move forward, any question?
Yeah, Femi.
Yes?
Yeah, I just want to be clear on something. You know, in JPREG,
yes,
there was a question that was asked. So I just want to confirm if this is in line with what I was thinking. The question was, it asked that, say, for every new business, identify chronologically the various business subphase of its early life. What does that entail?
Come again.
It said for every new businesses,
okay,
it said identify chronologically the various business subphases or stages of its early life.
Okay, you're right. It's around what we just talked about. Now, what we will see basically is that there will be planning. Planning is to say that what do I need to, what does this business stand for? You do all your what we call market survey, you do all your business plan, you have a planning. Now, after planning, you then go to what we are talking about, which is how do I raise financing. When you then raise finance, the other bit will now be what asset do I buy with this money that I've raised? Financing. After you bought the asset, you then begin to put those assets into operational use to run the business. That is operations. So that question is answered in this slide, which is the financing phase, the investing phase, and the operational phase. Are we good?
Yes.
Yeah.
Okay, so I hope I can move on. Let me move on. Now, balance sheet. We may see a financial statement without seeing anything called balance sheet. It shouldn't be bothered because under IFRS, balance sheet is called statement of financial position. Statement of financial position. It is a statement that shows the position of a business, the financial position of a business. Now, I've seen several questions. They will say, balance sheet, is it at a point in time or at a period of time? Who wants to answer? Point in time or period?
At a point in time.
Point in time.
Exactly. At a point in time. Exactly. And what shows that point in time is assets. If you see a financial statement of any business, you will see statement of financial position as at 31st. The next day, the position could have changed. It doesn't mean that the account is incorrect. It only means that the position we are referencing has now changed. A balance sheet typically contains 3 accounts. 3 accounts. What are these 3 accounts?
Assets, liability, and owner's equity.
Great, thanks, Edward. Assets, liability, and owner's equity. We've talked about assets. Assets are resources that the business owns, and we must be able to measure them in monetary terms. Now, liabilities are also the obligations, what a business is owing to either its shareholders or external parties. And the other one is owner's equity, which brings us to an accounting equation, which is that assets must always be equals to liability plus owner's equity. I'm sure Professor has talked about this times without number. So let me move forward. The T account. In account, we use T account for transaction recording. It just allows us to record transactions. There are 2 sides. The left side is always called the debit side. It doesn't mean increased side. It doesn't mean that. It only means the left side or debit side. The other side is called the right side or the credit side. Now let's take note of something. I want to ask us a question. How many account types do we have? How many account types do we have?
We have 5.
5.
Good. We have 5. Can we name them?
Yeah, revenue.
Okay.
Account receivable.
Account receivable.
No, account receivable is not part of account type.
No. Asset, you have
Asset,
asset,
liability, owner's equity, revenue, and income.
Revenue.
expense.
Correct. We have asset. We have
liability, owner's equity,
Revenue and
expense.
Exactly. Don't let us miss it. Account receivable is just a sub account. It's not an account.
Account receivable, account payable are sub accounts.
Exactly. So the account. Exactly. Now let us know something. Most of these accounts, by their nature, some of them are called debit accounts. Some are called credit accounts. Now, assets by their nature, they are debit accounts, meaning that anytime an asset increases, for you to recognize that increase, you must go to the debit side. Because by its nature is a debit account. For you to reduce that account, you have to go to the opposite side, which is the credit side. I take that again. Asset by its nature is a debit account. So anytime that account increases, for you to show that increase, you must go to that debit side and post. For you to show a reduction in that account, you must go to the opposite side. And the opposite side of that account is a credit side. I hope you all got that.
Yeah.
So if an asset increases, what do? We debit. If an asset reduces, what do?
Credit.
We credit.
Credit, that's the opposite side. Liabilities, by their nature, they are credit accounts. So if a liability increases, for us to recognize it, we have to credit liability account. If a liability increases, because by its nature, it's a credit account. So if any liability increases, you must credit that account. And if a liability reduces, what do? We debit. Who wants to try for equity and tell us the reason why equity is what it is? Who wants to try equity? By nature, is equity a debit account or credit account?
Credit.
Correct, credit account. When equity increases, we have to credit. When equity reduces, we debit the account. It's even logical to make sure that equity and liabilities, they follow the same way, because both of them are on the liability side, while assets follow an opposite direction, because asset is on the opposite side. Now, revenue. Who wants to try revenue? By nature, is it a debit account or a credit account?
A credit account.
It's a credit account. Because revenue increases owner's equity.
That's correct.
And owner's equity by nature is a credit account. So anything that increases owner's equity should have to go to the credit. So by nature, revenue are credit accounts. So if we need to reduce revenue, we have to debit revenue. If we need to increase revenue, we have to credit revenue. We know that revenue and expense, they should be in the opposite direction. Is that correct?
Yeah.
So expense by nature will be what type of account?
Debit.
Debit. So anytime expense increases, we have to debit that expense account. Anytime expense reduces, we credit the expense account. Okay, so let me move on. How to create financial reports, how to understand. I'm sure in our classes tomorrow.
Sorry, Femi.
Yes?
Yes, please. A T account where you just mentioned the 5 of them. Please, can you just take it again, because that is the confusing part, because it's a convention. Just please.
Femi and everyone, please, if you don't mind, can you just go over that T account again? I lost you at the point where you started. I'm very sorry about that.
Okay, let me quickly go quickly on that. Our time is running out. Assets. We are just talking about the nature of these accounts, how they behave, and that drives when there is an increase or a reduction. Which side do we debit? Which side do we credit? We said that assets, it's a debit account in nature.
Yes.
Asset by their nature, they should be a debit account. Now, if you want to demonstrate an increase in asset, you must go and continue to debit so that debit can continue to increase.
And physical condition.
So anytime asset increases, you must debit the account.
Recording on the new generation of
Can we mute our mics, please?
Somebody needs to mute his phone.
Can you mute?
I'm not talking.
Please.
So I take that again. Asset by nature is a debit account. Anytime asset increases, you debit asset account to show that increase. Now, anytime asset reduces, you must post into the opposite side of the T account. And the opposite side of the debit account in a T account is a credit side. So when asset reduces, you have to credit asset account. When asset increases, because it's a debit account, you debit it. When it reduces, you credit it. You post into the opposite side, which is the credit side.
Yes.
That's what we do for asset. Now, you know that in our equation, liability and equities, they are on the opposite side of asset. So what I've said for asset, the opposite side will happen to liabilities and equity. Liability by its nature is a credit account. So for you to increase that account, if that account increases, you must go and credit that account to show that it is increasing. So if that account is reducing, you must post into the opposite side. And the opposite side of credit is actually debit for a liability account. So you must debit to show a reduction in liability. The same applies to equity, because both of them are liability. It's just that one is to external party, the other one is to owners of the business. Are we together?
Very much.
Carlo, did you get that?
Yes, but sorry, Femi. The little challenge is about expense.
Okay, now, expense can be linked to income statement, isn't it?
Okay.
Now, anything that increases your profit will increase your owner's equity.
That's correct.
Anything that reduces your profit will reduce your owner's equity. Revenue increases your profit. So because revenue increases owner's equity, it will behave in the same way as owner's equity.
Okay.
So revenue by its nature is also a credit account like owner's equity.
Okay.
Because if it's increasing owner's equity, for it to increase owner's equity, it must go in the same direction as owner's equity.
Okay.
So owner's equity is a credit balance by nature. That means revenue is also a credit account by nature. Expenses reduce, pardon my English, expenses reduce owner's equity.
Okay, I see.
So you understand?
Yeah, I
so
understand.
you must debit expense. Okay.
I understand.
So let's move quickly. We'll go back to balance sheet. Sorry, how to create financial information, blah blah. This is an example. This is just a T account. We've written out many T accounts. These are transactions now. We are focusing on transactions. On January 2nd, the two partners complete legal step to form the company. That is not a transaction. That information is not a transaction for us. If they had stopped there, we are not going to post anything. But they now went ahead to say, and they invest 20,000 of their fund in the new business. This is a transaction. What they have done is to take 20,000 of their fund and they put that fund in the new business. Our cash will increase by 20,000. Cash is an asset. To show an increase in cash, we have to debit cash, 20,000. They contributed capital. Capital is a liability to the business. It's a liability to the owners, not to banks, not to other parties. So capital by its nature has a credit balance. Because it increases, we must credit capital. Are we fine?
That's under owner's equity, right?
That's owner's equity. Contributed capital, yes, or owner's equity. Now, the other transaction is that the next day, the company leases a shop for 3 months, and the rent for the period, 6,000 is paid in cash that day. They paid 6,000 for 3 months. That means that they've made payment in advance. Anytime you are making payment in advance, it's usually taken as a prepayment because you will enjoy that benefit over 3 months. An asset is a reflection of the benefit that a company will enjoy. So anytime you pay for services that you have not enjoyed, you have an asset. Because if this company decides not to give us that shop, we can go and get a refund. So we must recognize a prepayment asset, which is why we have prepaid rent. Now, the prepayment increased, so we have to debit prepaid rent. Because I paid with cash, cash will reduce. Cash is an asset. We then have to credit cash to show the reduction in cash. Are we together?
So so this will appear under liabilities, right?
Let me just put it in a slideshow. Let me put it in a slideshow so that we can just see it one at a time. Good. This is the second transaction. The second transaction, there will be a credit to cash because I paid rent for 3 months with cash. My cash has reduced. I will credit cash. I will then debit rent, prepaid rent. This is not expense because I paid for 3 months in advance. I'm not going to take it to rent because the 6,000 that I paid is not for me to put in P&L. It is what I will enjoy over 3 months. If at the end of the month, they ask us a question, what is the rent for the month of January? What will be the answer?
It's a third of that.
2,000.
Yeah, that's one third of that.
Exactly. So what should go to rent expense in January should just be 2,000 of this 6,000. In February, another 2,000 should go to expense. So cumulatively in February, we will have 4,000 recognized. In March, another 2,000 should also go to March. So cumulatively in March, we will have the whole 6,000 recognized. Are we good?
Sorry, Femi, as we're posting that, that means prepaid rents will also keep going down at the end of every month.
Exactly.
Yeah.
So the way we will be doing it is we will credit prepaid rent, we will debit rent expense for month 1. For month 2, we credit prepaid rent with 2,000 to reduce it, we'll debit rent expense with 2,000. The last month, we'll credit prepaid rent with the last 2,000, we then debit rent expense with the last 2,000. On January 3, the company buys shop fitting for 10,000 cash. The assets are expected to have a life of several years. What entries are we going to post here?
Cash is going to be debited.
Cash debited or credited?
No, cash should be credited.
Credited.
You're spending cash.
Exactly, you are spending cash, and cash is
that's correct.
So you credit cash. With how much? 10,000 or 5,000 or 2,000?
10,000.
So which account are we debiting?
You will debit equipment account.
Correct. Fittings and fixtures.
Yes.
Or equipment.
Okay.
Yes. Another person can call it fitting and fixtures. That's absolutely correct. Someone else can call it equipment. Both of them are correct. So we'll debit it with 10,000. Let's move on. The same day, the company borrows 12,000 from a bank for a 3-month period. What are we going to do?
Debit cash.
Same day the company borrows.
Liability now.
Liability and bank.
Liability.
And bank.
Liability 12,000. Credit liability 12,000.
Exactly. Liability increases.
Is it liability mortgage? Liability mortgage.
Now, there are different, some people, they said the company borrows from a bank for a 3 month. They didn't tell us it's a mortgage, have we?
Yes.
They just told us they borrow. Someone can call it borrowings.
It can be overdraft.
They never told us it's overdraft. So, but what we know that is a borrowing from a bank. Someone can call it bank loan. You understand? So just call it what it is. What have we called it here? Yes, it's been called bank loan. Yeah.
So bank account will be.
Go ahead.
Bank account will be debited.
12,000 and then
Yes.
cash will be debited.
Cash will be debited.
I mean, sorry, cash should be debited, then bank loan will be credited.
Yes, because bank loan is a liability.
Now, in this instance, okay, even though it's not stated that it's cash, but of course, it's an instrument that will be used to pay what you're borrowing.
Yes,
that's fine.
Yes. The question is, if I don't take it to cash, where do I take it to really? If I borrow money from the bank has given me the money, they will credit my account, isn't it?
That's liability. That's under.
Yes.
It's under liability.
I'm saying that I know that I have a liability already. That is clear, which is bank loan.
Yes.
The other leg can only be cash. It can only be an asset.
Oh yeah,
The bank will have to give me the money. Yeah. So
yeah, but under asset, it could as well be under any other accounting name, which is not cash. I mean, if it's a different transaction.
It can only be cash or bank. Now, the bank is not bank loan. It's not bank loan that I'm referring to. It's your own bank account.
Okay. Yeah. So so it will always be cash, kind of.
Yes. It will always be cash. Okay. So let's move on quickly.
Yeah, but Femi, can I ask something?
This side is very technical, Femi.
Please go ahead. Go ahead.
It's full of convention. It's very technical. So it's easy for one to mix things up here.
Exactly. Yeah, you can mix things up. Femi, let me ask a question. For example, like under the equipment account, right?
Okay.
When you post that transaction that is 10,
Yes.
that's on the debit side of that equipment, but
Yes.
it's going to show negative, right?
No, it's not going to show negative because I'm buying equipment. I'm
Okay,
having
it's going
new
to be
equipment.
positive, so it should be
Yes.
increasing.
Yes. And equipment is an
increasing.
asset. So
Okay,
anytime
I
asset
understand what you're
increases,
saying.
you debit. Debit is a reflection of increase in asset.
I'm sorry, Femi. The 3 months period that they stated there, does it have any indication or impact on any of these posting as at now?
Now, what the 3 months just told us is that the liability will be paid over a period of 3 months. This does not affect our posting. But when we prepare our financial statement and they want us to classify our liability into short term, which is current liability, and long term, that's when this information will be useful. Because this loan will be paid within 3 months. It can't be long term. It has to be a current liability, short-term liability. Because long-term liability are liability that will be paid after 12 months, while short-term liability are those that will be paid within 12 months. There are other conditions. Maybe when the person that is taking us on that will expatiate more on that. Is it safe to go on?
Yep.
Good. Okay. Now, on January 5, the company, I can't say this properly.
Company buys merchandise.
Okay, great.
For
the company
35,000.
buys merchandise for 35,000, of which 24,000 is acquired and on account, and the balance for cash. Who wants to give it a try?
You've shown the answer already now.
You've already done it now.
You've shown the answer
There are
already.
there are two transactions.
But you can show the answer and someone will still miss it. So who wants to try?
There are two accounts. The balance
Three.
cash.
There are
The
3
one
accounts.
on cash. Hold on. There is a 9,000 cash and then inventory. That's because that's the difference between the 35,000 and the 24,000. Why the 24,000?
9,000.
They said 24. Oh, sorry, 11,000. Sorry, 11,000 cash.
Okay, go ahead.
And then the other 24,000 is, like you said, is on account, which means is
on credit.
Is on credit. So that is
account payable.
Account payable.
Yeah.
And inventory again. Account payable inventory 24,000. Cash inventory 11,000.
No, don't put it.
Let's assume I want to separate this transaction into two.
Yes.
Hello. What has happened is that the person buys merchandise for 24,000 on credit.
And 11,000
buys
cash.
Merchandise 11,000 cash. Do we agree?
Yes.
Yeah.
Yes.
Sure.
So the entry I will post is for the merchandise they bought on credit. I will debit merchandise 24,000. Do we agree?
Yes.
Yeah.
I will credit account payable 24,000. Do we agree?
Yes.
So that's why we have account payable 24, merchandise 34, 35. That 35 includes the 24 that we just posted.
Yeah.
Then this same company buys another merchandise, 11,000 on cash. What I will then do, that cash element, I will go and credit my cash account with 11 because I'm spending cash.
Yeah.
I would then go and debit merchandise because I'm buying merchandise. So in merchandise, I will have 24 plus 11, which is the 35 that we have in merchandise. Do we get that?
Accounts payable is liability.
Account payable is liability, which is the 24 that we purchase on credit.
Okay.
So if you want to post this transaction as one, we'll just post it as one. We'll debit merchandise 35 because I bought merchandise worth 35.
Total.
I'll then say, how did I pay for this merchandise? One of it, I didn't pay for it, is on credit. I will go to account payable, credit account payable with 24 because my liability is increasing. I paid cash for 11,000 for the balance. I'll go to cash account because my cash is reducing. I'll go and credit cash with 11,000.
Sorry, can I ask one question?
Today, hold on. Oluyemisi has a quick question.
Okay, so
Oluyemisi, are you there?
yes, thank you. Yes, I'm here. So, so when they say that 35, out of this 35,000, 24,000 is acquired on account, it looks somehow, you know, so that if you see it in the exam, it's acquired. So are they saying that when it's acquired on account, it means that
It's bought on credit.
On account means is on credit.
Okay.
You are not paying cash.
Can we forget about exam and just talk about how to understand these things, you know, practically?
That's why I'm
there's no tension. So that there's no tension, because when you mention exam, you are tensioning things.
No tension.
Carlo, are you on that tension?
No.
There are certain words that can trigger anything.
So when they say on account, thanks. So
Yeah.
it means on credit. So today, over to you.
Yeah, Femi, sorry.
Yeah.
When you look at our basic equation,
Yes.
now for merchandise, where does that fall on the right side now? And account payable.
Okay, I'll put it back to you. Merchandise on equation, where does it fall? Asset or liability? Or
merchandise will be assets.
Correct. I'll put 35 there. I'll put 35 there, right? Equals to liability. Account payable, where does it fall?
Account payable is liability.
Liability.
How much should I put there?
24.
24. Okay. The other one is cash. Where does it fall?
Cash is assets.
Okay. Is it plus or minus?
It's negative now.
Minus what will I put there?
Minus 11.
11. Owner's equity. Do we have owner's equity in this transaction?
No owner's equity.
No. So owner's equity will be 0. So on the asset side, I have 35 minus 11. That gives me 24.
Which is equal to 24 on the liability side.
Which is equal to 24, the account payable.
Thank you. So
yeah, we're good. Okay, so let's move fast. We've run out of time.
Which time are we running out of? Is it that we don't have any other calls again, okay? This Zoom is going to run for the next 3 hours. Let's keep going. Unless you have somewhere you are running to.
Let's
Oyema, we have other business and we have tutorials tomorrow as well. Tomorrow is a full day. So what we will do is
tomorrow cannot be a full day.
Let's finish this one.
It's not when I say full day, it will end about 4 o'clock if you look at the timetable. So Oyema, what we can do is we can move it to Monday if people are agreeable.
Fumi.
Oyema, don't trigger her for anything. They are cooking for their family.
They're not pursue black goats.
Sir.
They are doing Easter. Oyema, don't trigger. Femi, continue.
As well. Okay, can we move on, guys? Can we move on? Can we quickly move on?
Oh yeah, now no problem.
Okay. On item 6, they said defective merchandise costing 5,000 is returned to the supplier for full credit on 6 January. The company had not yet paid the supplier for the goods. You know, we bought merchandise.
Yes.
35,000. We paid cash 11,000. 24,000 of the 35,000 was on credit. So what they are telling us is that part of the merchandise we bought, they were not good. So we had to return merchandise worth 5,000. Without doing accounting, what will happen is that our merchandise that was 35,000 will reduce by 5,000. Do we agree?
Yes.
Yeah,
that's correct.
Yes.
Our liability that was 24,000, we also have to reduce by 5,000.
Yes.
So just post that explanation we've done.
And our cash will increase by 5.
No.
It's not going to affect cash.
So
okay,
we're going to
cash.
We're going
it's not going to affect cash.
We are going to decrease account payable. We are going to decrease account payable.
Oyema has the floor, please.
So
Oyema,
we are going because we have account payable. We are still owing them 11,000. So we'll take it from account payable.
You are owing them 24.
We are owing them 24.
We are owing them 24. So now we'll be owing them 19. So we'll knock off 5 here, and then we'll go back to inventory and knock off 5 from inventory.
So how do you knock off 5 from account payable? What do you do to knock off 5?
Put 5 on the debit side.
You have to debit.
Oh, I did
debit 5.
You debit 5.
You debit 5.
Yes. How do you knock off 5 on merchandise? Oh yeah, 1 minute.
5,000 on the credit side.
You credit 5.
Exactly.
So it goes to the debit side.
With 5. It goes
then
to
it's equals to
side.
yes.
Yes.
Maybe I don't agree with Ima's explanation.
Okay, can you give us a better one?
They say 5,000 is returned to the supplier for full credit. So it's credit. We were not told that he was paid.
Not cash,
so
not cash, not cash.
That means you create an account receivables of 5,000.
No, you do that. You do that
no,
when
you're wrong.
you do that in a situation where you are the one selling out.
Yes, and these
you
guys
sold
are not
out on
you.
credits.
Yes, because this is goods that you returned. It's not goods that they bought from you that they are owing you. Then you'll say
exactly.
It's a receivable. This is not yet
so
a
you need to go straight to the account that is impacted in the first place. The account that was credited with that asset is where you go to. Now you are taking it out of that account. So that is why you have to put the 5,000 on the debit side of the same account.
He looks as if he was right. But if you read the second part of the statement that says the company had not yet paid the supplier, it means go back to where you have not paid and go and knock it off.
Yeah.
That second statement.
Yes. For full credit means that the goods that I've bought for 5,000, I'm returning it worth 5,000. And they are taking away 5,000 from my liability for full credit.
Okay, so Femi, let me ask a question.
Yeah.
If we have paid them fully and then we have these goods returned, in that case, when we return it, we will now create account.
Can you take your plate downstairs?
Right?
Who put this up there now?
Madam, can you mute your mic?
We never eat to.
Don't make us feel
Hey, money, where's my food?
So
let's listen to Oyema, please. Let's listen to Oyema.
Oyema has the floor.
Oyema, go ahead, please.
I'm saying if we had fully paid, so let's say it says defective merchandise costing 5,000 was returned to the supplier. Finish. It doesn't say on credit. So it's returned, which means we fully paid, right? At that point, what it means is that we are going to knock off 5,000 from the merchandise. Then we will create an account receivable because they now have to pay us 5,000 back at that point. Because
you go to cash account too to indicate that.
No, when they now pay us the cash account. No.
When they pay you cash.
When they now pay the cash, we'll now go to cash account and put post in cash and then knock off the receivable back to zero.
Excellent. Yes. If you had fully paid, a receivable would then be appropriate.
Oh, yes.
Because you don't need to knock off payable. So when we collect the money, we take off receivable and then recognize cash. Oyema, you're right.
Let's see the results now.
You should be taking this course.
Okay, I don't even understand what I'm saying. It's because you are teaching this thing I'm trying to understand.
Let's see the result. The result is this. We can see a knockoff in merchandise of 5.
Yeah.
We can also see a knockoff in account payable of 5 to reduce the merchandise, also to reduce account payable, which is what we've all said. Great. So I think we can quickly move on. The next one now, I think I've shown the answer for this.
Are we having this slide, please?
Is that?
Do we have this slide?
Yeah, I've shared the slide.
Yeah, I've sent it before.
Okay.
So on January 7, the company finds that it has surplus shop fixtures costing 1,000 and exchanging them for merchandise of similar value with a neighboring shop. Let me explain what has happened here. The company saw that it had fixtures. You know, fixtures, we call it equipment here. The company saw that he had surplus equipment and he didn't need 1,000 of those equipment, but he needed merchandise. So he gave out equipment worth 1,000 and he collected merchandise worth 1,000. What entry are we going to raise for this?
You debit your merchandise and you credit your equipment 1,000.
That's correct. That's what we're going to do. We debit merchandise, credit equipment. Now, we have, after we've done our T account, the next thing is to close the account. Are we together? Closing an account means just balancing out to know the balance that has remained. Now, in my cash account, what is my balance? What balance do I have left in the cash account?
32.28. You have balance of 4.
No, that's 27. That's 27, not 28. 32 by 27, that's
27, 5. 5.
Exactly. I have 5 left.
5.
So,
yeah, 5,000.
So that's what exactly. The 5,000 is my cash balance.
Side.
It will be on the side that has lowest value. The debit side has 32, isn't it?
Yeah.
Yes.
The credit side has 27.
Yeah.
I then need to augment this credit side with a balancing figure of 5.
5, yes.
5 would then be on the credit side.
Hold on. Why would 5 be on the credit side?
Now,
if you look at debit side, what's the total balance on the debit side?
32.
32. What is the total balance on the credit side?
27.
You must know that both of them must be the same thing at the end of the day.
Yeah.
For them to be equal, where do you put the balancing figure?
On the lower side.
On the lower side.
And the lower side there is the credit side.
It's the credit side. Yeah.
Hello, did you get?
I don't get. Why do I not get? I will tell you. Now, cash should be impacted of 5,000 to balance that.
That's correct.
So if cash is to be impacted, maybe something now happens again and they need 5,000 to pay. How do you now take it off from?
Sorry. Let
me
deal
with the cash side first. Kalu.
Do you understand what I'm saying? Understand. I'm being practical about this.
No, you are trying, Kalu, this is the convention you are looking at now. You are not actually putting $5 there. It's just convention, right? You are not actually putting that 5. Just listen to him. Let him finish. You understand it.
What we want to do is this. What we want to
balance it out.
Hello. What we want to do, we are not posting transactions.
We are not, yes.
We want to close the account. We just want to close.
Okay. So when you close the account, when you close the account,
end of month,
Femi, maybe you should put it this way. Femi, you should put it this way. There's a difference between the credit side and the debit side of that cash account. Now, you now need to indicate what is the difference between both sides. Now and to write it down, you won't write it on top of the T account. You won't write it, you must write it on a particular side. Now the convention is to put it on the side that has the less figure.
Has the lower, exactly. Exactly.
Yes.
It's just like when you say 6 minus 5, under the equation you put 1. 6 minus 5, under it you put 1 to show the difference between the two. But in this convention, you show that difference on the lower side.
Yeah, exactly.
And in this convention, you must rule. I think so that you rule it to show that you are balancing. Then I will agree. But if you just write it like that without any indication, no, sir.
Kalu, this is even
if it's the convention, you have to agree.
This is not even.
This is arithmetic, not mathematics.
This is arithmetic.
Yes.
Arithmetic. So let's balance out. Kalu, we have ruled. Are you satisfied now?
Very good.
Kalu is happy. Let's clap for Kalu.
Now, what we have done is the balances on each account. What is remaining on cash is what? 5. What is remaining on prepaid rent is 6. What we have left on merchandise?
31.
Merchandise, can you remember? 35 plus 1 minus 5. That's 31. Equipment, you know, we bought 10, we gave out 1, we had 9 left. Now, what we have done is to prepare our balance sheet. All assets on the same side. All the assets are cash, prepaid rent, merchandise, and equipment. Everything gives us 51. We then go to the other side to put our liabilities and owner's equity. Our account payable, when we balance, it will remain 19. Our bank loan, it remains 12. While contributed capital remains 20. So when you add everything, it gives us 51.
So Femi, one can easily say that the T account is just midway between transactions and the balance sheet. When you want to prepare a balance sheet, you can use the T account to help you spell out where each of the transaction belongs. Then you can now use it to post into the balance sheet, right?
Exactly. Not just balance sheet, financial statement.
Or financial statements generally.
Balance sheet, income statement. Now, in what happens in practice, companies do not keep T accounts. Companies have replicated T account with what is called ledger.
Ledger, okay.
Every debit will go to cash, all the debit to cash account in the T account, we go to the debit side of the ledger. All the credit, we go to credit side of the ledger. So that at the end of the month, when you do your month-end spooling or end of day, you get cash to be 5. It would have done your debit minus credit to give you a balance of 5. So there's something that is called trial balance. Trial balance is a listing of all accounts and their balances. Let us assume they told us to prepare a trial balance from these accounts. What we are just going to do, every account that is debit by nature, you put it on the debit side of your trial balance. When you are preparing the trial balance, you create 2 columns. In Excel, are we together?
Yes.
We create 2 columns in Excel. The first column will be debit. The second column, okay, let's just create a trial balance from this. Let me create a trial balance. Let me stop sharing this. And let me share another screen. Excel.
I wanted to ask a question.
Okay, please go ahead.
Just like we had in that balance sheet, right? And we had, are you there?
I'm with you.
And we had cash remaining as 5.
Yes.
What about if it was a -5?
Now, the question
can I answer that?
Go ahead.
Yeah, if instead of you having it as -5, you know, we had that 5 under credits in that. So that means instead of it being -5, it will be located on the debit side.
That's liability.
Now, the cash we have, depending on the cash that it is, if it is cash that I have in the bank, it can be negative, you agree. That means I have overdraft.
Yeah.
If I have overdraft agreement with the bank, my cash balance or my bank balance will be negative. So instead of having it on the credit side, you will balance it on the debit side.
On the debit side.
That's on liability.
On the liability, yes. So that means that cash, that bank balance is not going to be debit. It has to be credit. It's a credit balance. Do you understand?
Yeah.
Yes.
Because it has become a liability. It is no longer an asset.
Why do you eye like you don't understand you too?
No, okay. He's trying to demonstrate. Is this guy getting it?
Can someone quickly do me a favor? Go to that slide where we have the balance sheet. What we are preparing now, a question can come and say, prepare a trial balance. Trial balance is just a listing of all the accounts.
Okay.
And those that are debit by nature, you put them on the debit side. Those that are credit by nature, you put them on the credit side. And both of them must be equal.
Must balance.
Exactly. If your trial balance is not equal, there's no way you prepare an account that is equal. So what was the first one we have? Cash. How much is cash?
5.
We are preparing a trial balance. Cash is an asset. Will I put 5 on the debit or on the credit?
On the debit.
Good. What's the next one?
We can't see it too.
Cannot see the screen.
Oh.
No, the presentation. Okay, I thought you guys are looking at. Okay, don't worry. Let me pick it from here. I thought you had the copy of the presentation. Let me just pick it from.
So tell us what it is so that we can see it.
Share it so we can just
No, I'm typing on this Excel.
You can't share it.
I can't share both of them because I'm.
No, I mean
send
it to the group.
It's already on the group, eh?
Assignment.
Don't worry. I'll pick it from here. Eh? I'll pick it from here.
If you pick it from there, you are the only one knowing what you are doing. No, if
no,
you are
no,
telling them we are carrying
I'm putting
you
the
along.
balance on the Excel, so you see it on the Excel. Can you see the Excel that I shared? Isn't it?
Yes.
Yes. So the next one is prepaid rent now, 6.
Yes, prepaid rent. Prepaid rent is 6. Asset, so it will be on the debit side because it's a debit balance by nature, it's an asset. What's the next one?
Yeah.
We have merchandise.
Merchandise.
We have merchandise.
31.
Merchandise is an asset. How much? 31. Where will it be? Debit or
31.
credit? Debit or credit? Debit. 31.
Debit.
We have, which other asset do we have? We have equipment.
9.
Equipment.
Debit.
9. Debit because it's an asset. Any other asset? We don't have any asset. The other one we have is bank loan. Bank loan. Asset or liability?
It's liability.
So debit or credit?
Credit.
That's, how much is that? That's 12. 12. What else do we have?
Accounts payable.
We have account payable. We have account payable.
Where are you guys reading this thing from? I can't find it.
It's from the slide that I was presenting. That balance sheet that we prepared, I'm just putting it in the.
Maybe I told you. I said share it on the group so we can be reading for you. If not, some people will enter.
It's already on the group. I shared
it's in the group. Just go to media and documents.
Presentation one. Just pick it. The presentation one. So account payable. How much is account payable? 19.
19.
The last one is contributed credit because it's a liability. Contributed capital. Where would that be? Debit or credit?
Credit.
That's 20. This is everything. So this is a trial balance that I've prepared. I will just show whether my trial balance balances or not. So I'll just do. So this is a trial balance that I've prepared. If any question comes after we've done our T account and they say prepare a trial balance. Trial balance is just to list all the accounts that has balances at the end of that month. If it is assets, we put them on the debit side. If they are liabilities, we put them on the credit side. And if they are owner's equity, we put them on the credit side. So that when we add everything, it then balances, which is called trial balance. So this is just an example of a trial balance.
Hello, Femi.
Yes, Shola?
So I noticed that you copied 51 from debit to credit.
No, I summed. I just did some. I didn't copy it. I just did some. It was the formula that I copied just to sum. You can see the sum.
Okay. Thanks.
Okay.
So I start looking at you closely.
I know. Today I know. So let me share the presentation so that we can quickly close.
100 billion. Copy 100 billion. Money no loss.
Money no loss, Jerry. Okay, so we are good, Abi?
Yeah?
Yeah, we are.
Yes. So that will be all. That will be all. Let me just share something before we close. Let me share a live financial statement. Let's see how a financial statement looks like now, so that we can, all that we've done, we see it in a financial statement. Which one can I share? Can we see this? Hello, can we see this?
Chairmaker, I can see it. Chairmaker, I can see it.
This is not Chairmaker, I can't know.
I swear, this is Chairmaker.
So this is a sample GT Bank account for 2019. Now, let's just look at if we see the table of content, there are a lot of information in this table of content. Everything in this document is usually called an annual account. It does not mean everything there is a financial statement. Corporate governance is not a financial statement. Subsidiary governance is not a financial statement. These are basically reports that are put in a document that contain financial statement. Report and feedback is not financial. Anti-money laundering, director's report, statement of director's responsibility is not a financial statement. Independent auditor's report is not a financial statement. The financial statement starts, can we see financial statement? It starts from page 64. And in the financial statement, what do we have? We have income statement. I hope you can still remember. Income statement and statement of comprehensive income, they are one. We can combine those two. Statement of changes in equity, we cannot see that. Statement of financial position is the first one, which is our balance sheet. Statement of changes in equity, statement of cash flow, and notes to the account. Can we remember when Professor asked us, how many types of financial statement do we have?
What the professor?
It said 4 plus 1. 4 plus 1.
Exactly. 4 plus 1. And the 4 are statement of financial position. That's the first one. Income statement. That's the second one. Statement of changes in equity. That's the third one.
And statement of cash flow.
That's the fourth one. The plus 1
is the notes.
Is notes to the account. So, now, this financial statement stops at
Can you mute your mic, please?
This financial statement stops at when you have financial asset and liability. Other notes, it stops at where you have other notes and contingencies. Now, let me go to page 64. Let's go to page 64. Let me see whether we'll get there. Page 64. Okay. Now, if we see something like this in an account, what do we think this page is?
An auditor's report.
Exactly. This is an auditor's report. That means that this account is audited by who? By PwC. PwC is their auditor. Immediately after the auditor's report, you start seeing the financial statement. That's one of the strategies that is used to differentiate what PwC has audited. PwC has not audited all the information before their auditor's report. All this information here, PwC, this is not part of their auditor's report. The auditor's report focuses on the financial statement, which are the documents after this auditor's report. After this auditor's report, we'll start seeing the financial statement. And the first one is the statement of financial position. Can we see? There's no balance sheet here. They are talking about the same thing. And they said as at 31st of December. Hello?
We are here.
I said as at
31st December. That shows that is a point in time financial statement. We can see all the assets listed here, all the assets that they have.
Calendar year.
All the assets are sat 31st of December. Now, for a financial institution, they always present their financial position in order of liquidity. The most liquid account or the most liquid sub-account to the less liquid account for financial institutions, for banks and the like. Their accounts are usually presented from the one that is most liquid, which is cash, to the one that is least liquid. We say that asset is presented in order of liquidity. The most liquid to the one that is least liquid. Cash is the most liquid, followed by all these other types of assets. Now, we see that they have their total asset here, which is in our accounting equation, is the left-hand side, total asset. Immediately after total asset, we go to total liabilities. Liability is also presented from the most liquid, or the one you will pay first, the one that is due the most, to the one that you will pay later, in order of liquidity also. Deposit from banks, deposit from customers, and the likes. We then have our total liabilities. Immediately after this, we have our equities, which is what we call owner's equity, which in most financial statements, you see it as capital and reserves. Within capital and reserves, you will see share capital, which is contributed capital. You will see share premium, which is the premium you pay for buying the shares of GTB. You see treasury shares. Treasury share means GTB has bought its shares back. That's why it's in negative. Treasury share. You see retained earnings. Retained earnings is what we call end capital. This is the accumulation of profit that GTB has been making from inception. Other components of equity and other types of equity, they cannot be listed here because there are many. So this is statement of financial position in summary.
So sorry, can you go back? So the asset up there must be equal to the number we have down here. That's showing total liabilities.
So someone can just do a check for us.
Yeah.
Let's see whether GTB has followed our accounting equation.
I didn't see dividend here.
Okay, Kalu, are you a shareholder in GTB? Were you expecting dividend that you did not collect?
You know what I mean. It's supposed to be here. Yeah, it's supposed to be here too.
We'll get there. Let's quickly add this one that Jide has raised.
I want it.
Are you there?
3758.
918770. That's total assets. So let's leave total asset. Let's just add liability and equity. Let's see whether it will give us the total asset, isn't it?
No, I think they added it already somewhere. I think I thought I saw something.
Yes, that's correct. They added it, the last one. This is total equity and liability.
That's it there. So it's balanced.
So it's balanced. We are professionals already today. We are a professional accountant.
Just confirm me with title and you see performance.
I will see performance. I mean.
Hold on.
Okay.
Total equity and liability. Okay, I've seen it.
You can see total equity and liability.
They added it on their own.
Yes, they will always put it in the financial statement. This is a standard template for banks.
But I ask you one question.
I have not forgotten. When we get there, you see it. Income statement. We can see income statement, which is our P&L. It started with income first, and we have all the incomes, we have all the expense. We now have our profit before tax. We have our tax profit for the year. You will see that for a financial institution, the way they present their account is different from manufacturing. Manufacturing will start with revenue, cost of goods sold to get gross profit. After gross profit, they will now start deducting all relevant expenses to get net profit or profit before tax. But for commercial banks, Their revenue, instead of stating revenue, they state the revenue by their nature. Interest income, interest expense, their loan impairment, fees and commission. This is how they are required to present their financial statement. We have looked at two financial statements now, statement of financial position and income statement. Let's go to the third type of financial statement, which is...
Femi, can we get a copy of this?
I also shared it. It was also shared.
Oh, okay. Thank you.
Yeah. So the third one is statement of changes in equity. That's the third type of financial statement. What this statement just does is to show all the equity, all the owner's equity. You know that in the statement of financial position, we have some as others.
Yes.
For this place, it showed us everything because they can analyze everything here.
So the addition of this will give us the total over there, right?
Exactly. The addition of all these will give us the total that we have in equity. Now, our equity type, they are share capital, share premium, regulatory risk reserve, other reserve, and everything. We then have a column at the extreme right to show total equity. Now, Carlo asked about dividend. Dividend are usually paid from where? Carlo, where do they pay dividend from?
It should be retained earning now.
From retained earnings, yeah. We know you are an investor, you know. So you can see under retained earnings here. Can you see dividend to equity holders? 80 billion. Yeah. So that's where dividend.
Why is it negative?
It's negative because it's reducing profit. The profit that you have made, you have to take part of it and pay it to shareholders.
And pay people like Carlo.
And pay people like, I'm sure Carlo will get close to 1 billion of this 80 billion. So you pay people like Carlo the 1 billion.
Amen.
Carlo, am I right?
Amen. You're right. But one more question.
No go buy shares. They claim. No go buy shares.
I don't worry. We are going to buy.
We'll buy, yes. So.
You buy. Yesterday, GT Bank was as it 14 naira.
I bought Transcorp. I don't want to talk.
Let's go and buy Zenith. Let's buy Zenith.
No, if you have money now, please buy Zenith. GT Bank has moved up by 40% in the last 1 week. 40%. It was at 10 naira plus, yes. But if you have money now, please buy Zenith. Even if now 100K you buy Zenith if you have money.
How much is Zenith now?
At close of market yesterday. I'll check for the prices at close of market yesterday.
14 naira plus.
How much?
14 plus.
Okay.
Just buy Zenith if you have money.
Okay. Can I convert my Transcorp to Zenith?
Sell your Transcorp. Cut your losses. Sell your Transcorp.
That company.
Just sell your Transcorp.
So
which of the Transcorp? Which of?
Let's go.
Let's go.
The last type of account is called statement of cash flows. This is just a cash flow. You know, we talk about operating activities. Can you see? The first one is cash flow from operations. These are all the cash they made from their operations. So the total cash flow from operation is what we have here. This is net cash provided by equity by operating activity. This is the total cash flow that GTB generated from his operation from all the years. There is the other one that is called investing activity. From all their investment, these are the cash flow. You can see that. Let's go to operating. Under operating, they said cash flow provided by. They said provided. They said net cash flow provided because all these numbers are positive. Can we see it? All these cash flow numbers are positive. Under operating, let's go to investing. Under investing, they are all negative. You can see that they didn't say cash flow provided. They said cash used. Anytime this is negative, it is a cash that you have used. Because it's a net cash outflow, meaning that you have used cash more than what had come in. So it's a net cash used. Let's check financing, which is the last one. We can see financing. Financing, they are also negative. meaning that these are net cash also used in financing activities. So this is their net cash flow. This is the net increase in their cash flow plus cash flow at the beginning. This is the cash flow at the end of the year. GTV from the group generated about 585B in 2019. In 2018, they generated 614 and the like.
So 2019 wasn't a very good year.
Yes, in terms of cash flow, yes. It may also mean that they invested. Hello.
This cash flow, sometimes how do you tie it back to the balance sheet? How do you tie the cash flow amount to the balance sheet?
Now, interesting. You know, we were not there when all these cash activities happened. Cash flows are usually prepared from balance sheet and income statement. All the figures here, most of them are generated from balance sheet and income statement. If you look at the first one, this one is profit for the year. It is taken from income statement. Depreciation, property, most of these are picked from the income statement and balance sheet. Do you understand? The cash flow that is being, because if you give me a balance sheet and income statement, I'm not part of the business. I don't know what they paid cash for. But with that information, I can come with a cash flow because I will just do some movement between the balance sheet and the income statement. For example, in cash flow, if your asset increases, increase in an asset means that you have given money out. Let's give you an example of a transaction that will increase our asset. Today,
buy a building.
Exactly. When you buy a building,
when you buy a building,
isn't it? Your assets will
yes.
increase. But for your
cash will reduce.
Exactly, your cash will reduce. So anytime you have increase in asset, in cash flow, you depict that by a reduction sign. Anytime you have a reduction in assets, you show that by a positive sign, which is an inflow. That building that we bought, if we sold that building, money will come in, isn't it?
Yeah.
And that building will reduce because we have sold it. So reduction in asset is shown as a positive sign in cash flow. So everything that we see in cash flow is taken from our performance, which is income statement, and the statement of financial position, which is, I hope I've been able to answer that.
Beautiful.
Now, the other one is the note, which is the last one on the financial statement. You can see notes to the financial statement. Notes now gave us beautiful, what we call stories behind the figures. Everything with the figure, detailed information, detailed analysis. Looking at financial statement alone may not give you all the pictures, but if you go through all the notes, it gives you exactly. It's more like in-depth information. A lot of management information are included there. This is the financial statement of a financial institution. Do I have up to 5 minutes left?
Go ahead.
Take it. I
want to quickly share something. Now, you will notice that this is a financial statement of a financial institution like a commercial bank. Yeah. Let's note some key differences when we go to non-commercial, non-banking financial statement. Let's know that assets started from liquid, most liquid to the less liquid. Immediately after assets, we went to liabilities for a financial institution because liability are more liquid than owner's equity. Do we agree?
Very well.
Owner's equity, they are owners of the business. You don't pay them now. When you are paying them all their money, that means you are winding up the business. But liabilities are obligations you have to pay in the cost of operations of the business. So for a financial institution, they start their account with assets. After assets, they go to liabilities. After liabilities, they go to equity. But for a non-financial institution, they start with asset, but their asset is in order of illiquidity, the most illiquid asset to the less illiquid asset, or to the most liquid asset. After asset, they then go to equity, because equity is more illiquid than liabilities. So I'm just preparing our mind. Let me share financial statement of a non-banking company. Then we
manufacturing industry.
Manufacturing, yeah, to be precise. Let me look for one urgently. Good, I've got one here. I also shared this on the slide. I mean, in the group. Share screen. Good, we've got one here. We've got May and Baker, 2018. Looking at May and Baker.
Bros, you're a hacker. These are recent too.
Leave that one. They are available on the internet now. Come. Okay, if we look at their table of content also, they have auditors report. Can we see it clearly?
Yeah.
Auditors report, statement of financial position, changes in equity, statement of cash flow, notes to the account. Then we have the financial statement actually stopped at notes to the account. Other information from other non-national disclosure. These are called other information. They are not part of the financial statement. If a question comes and say, looking at this account, financial statement are from pages what to what page? In this one, financial statement are from pages 6, that is the statement of financial position, to pages 59, because other national disclosure started from page 60. So let's go into the financial statement now, page 10. Page 10, page 15. Okay. Now, for this one, the auditor is who? Who is the auditor of this company?
PKF.
PKF is the auditor. You will see that the financial statement is just immediately after the auditor's report. This one, they didn't do it well. Okay, so let's continue. We can see this is a manufacturing. This is a manufacturing. You can see that they started from revenue. Go and get your ball. They started from revenue. Hello, are we there?
Yeah.
Yeah, we're with you, fam.
Okay, they started from revenue. They then did cost of sales. Revenue minus cost of sales gives gross profit. After then, they did all the other activities, operating income.
It's more like income statement.
But they are both income statements. So this is profit before tax, this is tax.
EBITDA.
Now, EBITDA is not a financial metric that is used in Nigeria. So in a financial statement prepared in Nigeria, you will not see EBITDA. But in other jurisdictions like US, you will see EBITDA. But in Nigeria, we always do operating profit, profit before tax. But if we want EBITDA, one can just do plus or minus to get EBITDA. You understand?
Yeah.
So let's look at the statement of financial position. We can see here, in their statement of financial position, they started with non-current assets.
So that's same as balance sheet, right?
Yes.
No, let's see, this balance sheet. Statement of financial position.
Balance sheet, yes.
Yes, but we won't see balance sheet, we'll see statement of financial position. Now, they started with their asset also, but they started with non-current. In the other one for bank that we saw that they started with current, isn't it? Which was cash. But this one, they started with the most liquid asset, which is property, plant, and equipment. They now ended with the most liquid asset, which is cash. Okay. That's the way they present their financial statement, from illiquid to liquid.
Yeah, and there's a reason.
Immediately after this, you can see that they now started with equity.
Can I speak on why they start with
Please go ahead.
Yes, because for manufacturers, they price their raw materials more than cash value.
Because that's the asset to be sweated, right?
Good, good. Cash is invisible. Cash can lose value anytime, but raw material, it's more tangible to hold on to.
Yes, yes. Because for a financial institution, now, because liquidity is everything, because you're also keeping people's money, you need to provide information in an order that is relevant. You must show your liquid assets first. People want to be sure that you have enough assets to meet up with your customer deposit. And CBN has stated that for financial institutions, you present financial statement in order of liquidity. And we see that instead of starting with liability, like GTB did, immediately after asset, they went to equity. Because equity is more illiquid than liability, which is still the same approach they are using. So we see their liability. We can see total equities and liability here also, which is our accounting equation. Let's see our asset. Our total asset is 8.1, while our total equity and liability is also 8.1. Immediately after this, we'll see, what was the next one? We'll see this statement of changes in equity. Now you can see that they have their equity, they are not as much as the first one we looked at. They only had share capital, share premium, retained earnings. OCI is other comprehensive income. So this is what is called statement of changes in equity. It just analyzes the equity from the beginning of the year, show the changes that occurred during the year, and show us the balance at the end of the year. This statement of changes in equity. You can see something. I didn't pick that from GTB. Let's see the balance sheet or statement of financial position. Our statement of financial position here shows assets. That means this is a point in time account. Do we agree?
Yeah.
Or this is a point in time financial statement? Yes. Let's check this one. Statement of changes in equity. This is for the year ended. That means statement of changes in equity is a period of time financial statement. Do we agree?
Yeah.
Yes.
Because it shows for the year ended.
Yeah.
From the beginning of the year.
Exactly, from the beginning of the year till the end of the year. Because they may ask us a question on that. Now, let's look at cash flow. Cash flow also shows a period of time financial information. Can we see for the year ended?
Yeah.
This is a cash flow from January till the end of the year.
Yeah.
Now let's look at the last one. Have we checked? Okay, let's check. We've not checked income statement.
So the
income statement is also for the year, which is period. So hold on. Today, don't lose your thought. So out of the 4 accounts, 3 of them are for the year, which is period. Only one is a point in time, which is what? Balance sheet or statement of financial position. Today, over to you.
So those statements that shows for the year ended, it's like, those are like, they are like videos, whereas the other statement that show a particular point in time is like a snapshot.
Exactly.
You know,
yes.
It's like a snapshot at a particular point in time.
Yes. Those ones show their information over a range that you have selected.
Over a range of period, yeah.
And the range is from 1st of January to 31st of December.
That's the practice, but it's not impossible to have. It's not impossible to have a 6 months.
We even have
duration.
monthly. We have monthly. Management account are prepared monthly. So you will see for the month ended 31st of March 2020. That means it's a 1 month period account. Hello, Tunde.
Yeah,
I got that. Sorry, I was
You got
muted.
That's what it is. Guys, at this junction, I think any question?
Yeah.
Thank you, Femi.
This is very nice, Femi. Very, very nice.
Thanks.
Yeah, thank you. So.
All right. Femi, thank you very much.
Thank you very much, Femi.
Thanks, guys.
Thank you.
As a custom, hold on one hour. As a custom, LBS, I would like Kalu give us a vote of thanks.
Yes. Like I private Femi. In fact, I thought about this before now. Femi will
This
be
is for all of the guys, so not just Femi, all of the guys that.
For everybody.
Yes, on behalf of all, Femi will bear witness that I private chatted him that I needed to know his discipline before I will ask a carpenter to come and do a doctor's job. So he has actually done awesomely well as a finance person. We are very grateful. We are very thankful.
Thanks, guys, for your time.
And we pray that your brain will continue to be hot in Jesus' name.
Will I stay answer to that? Yeah, answer that.
I hope the brain will not need radiator.
Kalu 5G.
Kalu 5G.
Thank you for tomorrow.
All right. Okay, everybody, thank you very much for jumping in. All right, I would also like to thank Aga and Collins for a great job. All right, and we hope to continue this tomorrow. I think 9 a.m. in the morning. So for as many that are able to be a part of it, let's be a part of it. So guys, thank you very much. Have a